We think 2014 will be the best year for the global economy since 2010. It will be led by strong growth in the US of around 3% and solid growth in Europe of around 1 to 1.5%. However, there are challenges to these positive expectations. We're going to see monetary policy normalization in the US. We will see significant challenges in emerging markets. And obviously, as always, Japan is the big joker. Given the positive outlook for the US economy, the Federal Reserve, the central bank, has decided to scale down its asset purchases. It's been buying a lot of bonds over the last few years and effectively been printing money to buy those bonds. We are not too worried about this normalization of monetary policy. We think that most of the money has actually ended back up in the central bank itself because the banks, the commercial banks, have been unwilling to lend out the money to the private sector. Now, obviously, it has increased risk appetite in the financial markets, but overall, it's not a threat to the main theme in the US economy, which is, in our view, the fact that we're still building too few homes, we're still consuming too few cars, and companies are not investing enough over the long term. So there is plenty of room for the US economy to grow, effectively saying that there is plenty of spare capacity left in the economy, and that means, given easy monetary policy over the next few years, given less drag from the fiscal side, we actually think that this upswing in the US could potentially become the longest upswing since the Second World War. With 3% growth in the US, 1 to 1.5% growth in Europe doesn't sound like a lot. But the point is, from an investment perspective, this is actually a very good environment for corporate earnings. In the US, unemployment has approached 6.5%. That means that we're going to start to see margin pressure. So in the US, we're looking for margins, corporate profit margins, to be basically stable or actually fall slightly over the next 1 to 2 years. In Europe, it's actually different. There will not be a lot of wage pressure, inflationary pressures are low, and we're looking for margins to rise in Europe. Overall, with 1.5% growth and better margins, we're looking for corporate earnings to rise at around a 10 to 15% pace in Europe, whereas at base, we're looking for 8 to 10% growth in the US. Growth in Japan is back, propelled by extremely easy monetary policy and extremely easy fiscal policy. Now, the big hope is that the Abe administration will actually implement reforms. We are skeptical, and that means that going into 2014 and 2015, where fiscal policy turns to a major drag, that we are skeptical about economic growth in Japan. The major event so far in 2014 has been turmoil in emerging markets. Now, the driver of this turmoil was weaker than expected growth in China, symbolized with a falling business confidence indicator for January. Now, we think that the underlying reason for this is actually good news, because authorities are trying to get credit growth back under control. Credit growth has been way too high for a long time, and we think that it has to fall further from here. That is going to happen over the next few months, which is why we think Chinese growth will weaken a bit more and lead EM growth weaker from here. But over the spring, and hopefully as credit growth settles at lower and more sustainable levels, alongside continued implementation of reforms, emerging markets led by China should stabilize, and that should be good news by then.